Welcome to the Stuff Your Accountant Isn't Telling You podcast, where we tell small businesses big business profit secrets. On this episode, we're going to be talking about the statement of cash flow of some pretty big companies. We're going to be talking about Uber, we're going to be talking about Starbucks, and we're going to be talking about Adidas, and we're going to be talking about why this matters for you as a business owner. So stay tuned as we dive into these topics today. Welcome back to another episode of Stuff Your Accountant Isn't Telling You. I am Lola Turner, your host, and I'm joined by Mr. Terrell Antonio Turner, my co-host. Terrell, welcome back.
Hey, how is everybody doing?
I'm happy to be here. How are you doing today, Terrell? How has your week been?
Week has been good. Today I am a bit tired because I did not sleep much last night.
That's not good.
And the thing is, like, I was in bed, but my brain was just going about some ideas, because thinking about, in our accounting firm with our team and just with the incentives of some of the areas where we're growing and some opportunities. And one of the things that I have been thinking about is I guess, I don't know if you call it like an incentive, but a celebration event for our team, including our remote team in the Philippines. And so my brain was constantly running as I was thinking about that. So it's just like I just couldn't fall asleep until maybe around 3-4 o'clock in the morning.
Wow. Yeah, that's like right when I was getting up. So interesting. But okay, I mean, hey, we'll get through the episode. Let's get to the topics and give the value to our audience and move ahead. So I'm excited to jump into today's topic for a couple of reasons. One is because we always talk about this on the show. This is something Terrell has said. This is something I've said. Cash is king. That is something we always talk about on the show. And Terrell, if you could finish out the phrase for us, please. Cash is king. And when
like chess, when the king is down, the game is over. So when it comes down to looking at any business, and that's the thing that I don't think a lot of people realize, that like you can have a profitable business that is still going bankrupt. And, you got to dig into the details a little bit to understand that. And there have been a lot of businesses that I've seen, like, if it's a profitable business and they're running out of cash, what tends to happen is somebody comes in and they get a really, really good deal to buy that one for a much cheaper price, because the current owners are running out of cash and they can't keep it alive long enough to benefit from the profitability. So yeah, cash is very critical when you're running any business.
Yeah. And you said something that's quotable. So I'm actually going to write this down. You said that you can have a profitable business and still go bankrupt. Can you break that down a little bit for the non-finance person? Like, what does that mean?
Yeah. So literally the term bankrupt, it just means you ran out of cash. Like, you don't have the money to pay your expenses. For example, let's look at it this way. Let's say, you're a profitable business. You're making, like, when we look at your income statement, we can see that, hey, your sales are doing very well. And you're making money, on paper. But then when we look at your bank account, what we can see is not all that money is showing up in your bank account. And today you have payroll due, plus you have to pay your vendors, but you don't have the money to actually pay them. And if that continues to be the case, then, and some really big things come due, like I said, you could be a profitable business on paper, but when it comes down to looking at your bank account, you don't have the cash to pay people, then you are in a insolvent or kind of bankruptcy state. So that's what I mean by, like, and we'll talk a little bit more about why that happens and how to prevent that from happening to your business.
Awesome. All right. So I want to go ahead and jump into the discussion. So last week, if you tuned into last week's episode, we talked through the balance sheet, and we chose for our balance sheet discussion Adidas and what was the other one?
Starbucks.
And so those were some pretty good conversations. So Terrell, do you want to get started, kind of pick it up there before we move on to our new introduction company, the new company we're going through? How do you want to do this?
Yeah, I mean, I would say, I mean, I think this one is, we can go ahead and jump into them. And I think for everyone that is listening to this, like whenever they're listening to this, I think this is an exercise that I think is great because most people never really actually look at their financials. I mean, and if they do look at their financials, they look at the income statement, they look at their profit and loss statement to see, okay, how profitable we are. But they tend to ignore the balance sheet. They tend to ignore the cash flow. And that's for small businesses, because every time that I'm onboarding a new client, you know, I always find errors in their balance sheet. And the thing is, the business owner never looked at it because they just really look at the profit and loss, like how much profit did we have? And they don't look at their balance sheet. And even in bigger companies, like, you'd be surprised the number of people who have never looked at the balance sheet or the cash flow statement for the company that they work for.
Not gonna lie, I was one of those people. I'm not even gonna pretend here. My entire job for 3 years, for a period of time, was to make sure that our income statement was in the black. So we were actually, as far as the income statement was concerned, we were actually making a margin. So I didn't care about what was going on the balance sheet, only if I wanted to put something on it. So yeah, I agree with that statement, but it's not the way that it should be, because ultimately what's going on, I mean, to be fair, I looked at the balance sheet quarterly, but it was not nearly enough as I looked at, I mean, the income statement was basically a daily activity. But it wasn't one of those where, you know, most people, like you said, Terrell, are really pushing and looking at their income statement to see if they're profitable or not. The balance sheet was a little bit of an afterthought. So
yeah, I mean, to be honest with you, most people don't even look at the cash flow statement at all. Like, it doesn't even register to a lot of professionals. And this is accounting professionals, this is finance professionals. They don't even look at it. Now, I will say is, I probably would have been the same way had I not worked in investor relations, where I used to have to be on the phone with Wall Street analysts, and we were analyzing every statement. We were digging into the details. So I had to be aware of it because I had to prepare the CEO and the CFO on how to answer questions about our cash flow and our position. And there I realized that, hey, this stuff is very, very important. And even in spending time with like the treasury team, like, most people don't realize, like, a lot of your biggest companies in, you know, in the world, they're probably about maybe a month or two from going bankrupt, if certain things don't happen in the treasury function. And at the time, like, we were working for a $14 billion company, and they were 2 months away from going bankrupt if certain things didn't happen.
Don't tell me that. But I mean, I think it's just the reality, because I think honestly, a lot of times people think that just because a company is worth that amount of money, that they're not at risk. You know what I mean? It's like a company like that could never fail. I mean, it reminds me of what was it, the 2008 crash? Was it 2008 where a lot of those companies filed for bankruptcy? And I think a lot of people thought that a lot of these major companies were too big to fail. And if that taught us anything, it's the fact that, hey, that's not true. So
yeah.
Awesome. All right.
And I think this is something that, I mean, I will say, you can go ahead and start pulling it up, but I do think that this is something that, you know, accountants really have to do a better job at, because I think accountants historically have sucked in this area of being able to look at these type of financial statements and make it relevant to, you know, to the business owner, and make it relevant to the companies that they're working with. And most accountants have never looked at the cash flow statement for the company that they work for. And I'm just like, how do you know if that company has enough cash to make payroll? But I mean, like, you're putting a lot of faith in this company to pay your payroll, your benefits, and your bonuses, and you have no idea what their cash position looks like. You probably should take a look.
Like, what is my small salary in the grand scheme of things? Now add like 1,000 people to that, and let's have 20,000 people, and let's have a completely different conversation. All right.
Absolutely.
So I want to go ahead and start with Starbucks because I think that's where we started last time. And I want to kind of
Okay.
recap the conversation just relatively quickly. So when we, for those, well, I'm just going to give a highlight. If you want more information on Starbucks, go listen to the last episode that we did. But long story short, what we really looked at when we looked at the Starbucks balance sheet last week was the cash flow was a red flag for us. So the cash flow, not the cash flow, sorry, the cash position of the company year over year, there was a pretty big variance, and we couldn't seem to find on the balance sheet where the money had been spent on or where the money was spent because inventory looked relatively flat versus last year. And so we were hoping that this statement of cash flows would shed a little bit more light on what was going on with the company year over year. So that's what this is. Okay.
All right, awesome. So one of the things that I remember, I guess, is the balance sheet right before this one.
I think so. Let me go back up. Yep, it is.
Oh, all right. Okay, all right. So the big thing here is for Starbucks, the big question we had here was the cash went from last year, cash was at $6.4 billion and it went down to 2.8 billion. The big question was what happened to all of the cash?
Right.
And the best way to get an answer on that is going down to the cash flow statement. Because we looked at some of the usual suspects in the balance sheet, but now it's like, let's really look at, what happened in the cash flow, because what the cash flow is designed to do is walk you through, hey, here's where our cash came in and here's where cash went out. So we can kind of understand, hey, what changed in the situation here. So first thing, it's going to start off with your net income. And then it's going to add and subtract some things that you spent money on. You can keep scrolling down. Nothing here jumps out really big. All right, stop there. Okay, your operating lease liabilities. When more cash, so that's $1.6 billion on your operating leases. And then additionally so it looks like they spent $1.8 billion on new additions, like buying more equipment, buying more, supplies and all that great stuff. And then they spent about another 1.6 billion on like operating leases. So like the facilities that they're using. So which means Starbucks probably doesn't own the facilities that they're using.
That makes sense.
So they're probably leasing all of those properties and they're spending about $1.6 billion there. All right. And so the first thing that jumps out to me is when I see this, because we know that their cash dropped from 6.4 billion down to was it
2.8, I believe.
8 billion.
Yep.
So one of the quick questions that that the leadership team is probably looking at is, if we run out of cash, we won't be able to operate the business. So the big thing is how do we either conserve cash? And if you scroll down a little bit more, some of the options they tend to look at is, hey, maybe we can borrow more money. So let's look and see what they did there. Yeah, you can go down, look. Okay, right there. All right. So it looks like so that's where most of the cash looked like it went to.
They repurchased their stock. Is that the one?
Yeah, so they gave their stock shareholders about $2.2 billion in dividends. And then they followed up with about, $4 billion in buying stock back. Now, personally, in my opinion, sometimes the buying stock can be a little bit of a game of raising your earnings per share.
Okay. All right. So that's what it is. All right. Because I was going to ask, like, usually, why would a company be prompted? Why would a company buy back their shares? I mean, I don't know if that in magnitude, if that's a pretty big dollars value, $4 billion of repurchases of common stock.
I mean, I guess when you think about the fact that, like I said, they started with what, 6.4 billion.
Yeah.
And out of the 6.4 billion, when you take in what they added, what they, the plus and the minus throughout throughout the year, they decided to spend $4 billion on buying back some of their stock. Now, a couple of options you may have. Well, let me say a couple of options that I've seen happen is the company wants to take a little bit more control. So they're buying back shares from, other shareholders so they can have a little bit more control. And then in other cases, it becomes a play of helping you increase your earnings per share. Because the way your earnings per share is calculated is you take your total earnings divided by the total number of shares outstanding. Well, if your denominator gets smaller because you bought more shares back, then your earnings per share stays higher. So sometimes you'll see companies do that, and it does have a direct impact on like trying to keeping their stock price higher.
Okay. All right. So that's that seems like then I guess that was a strategic move on how they were presenting the value of their stock. I think one thing that I would say stood out to me on this before we move on is definitely the additions to the property, plant, and equipment. It's a little bit higher than what they did last year, or I guess 2021, as well as the investment that they had in just the operating lease liability. So it looks like either they acquired or either they expanded and opened new locations because their lease cost is higher, or in 2021, there were a lot of kind of, I guess, concessions on lease costs and stuff like that with COVID. So I don't know if that was, that was something that impacted Starbucks, where maybe the year-over-year rent increase or lease increase was kind of put on hold. So that might be one of the things that's causing that hike versus last year. So
no, I mean, one of the things that might be interesting to see is because we know that, like, in the US with a lot of, there were several stores that have talked about closing locations in certain jurisdictions because of, vandalism, or because of, low performing stores, or because of violence and stuff. And I'll be curious to see their full year to see how that kind of played out, because like I said, they just invested $1.6 billion into their leases. They invested $1.8 billion into their property and plant and equipment. And it's just like, if they did decide to close some of their stores, it's just like, what happens to that investment that they made? Is that stuff going to be written off? And is that kind of money down the drain? And again, when you have, like, if you scroll up a little bit to the operating activity, so it looks like, I mean, or you can go down a little bit. So from the operating activity, so it looks like, I mean, that's one number that I would say you really want to key in, is that net cash provided from operating activity. Because what this tells you is, based on the day-to-day operations of the business, are they able to generate cash in, or are they losing money there? And in this case, they're able to generate enough cash in from their day-to-day operations, which I would say that is a healthy sign for a company.
Yeah. And I think the reason why probably is they've done a good job. Well, based on the outside looking in, I think 50% of their locations are franchise owned. So they're not really having to carry or bear the burden of some of the operating costs. They get to really basically just take a percentage or a cut of the profits. I don't know how the structure itself is set up, but yeah, that's definitely something good to pay attention to. Any last thoughts on Starbucks before we move on?
No, and I think also the big takeaway, I think, for companies that have, products, and if you have similar industries, one of the great things that businesses can do is looking at where are they spending their money. If you see that, hey, the major player in our industry, they're heavily investing in property and plant and equipment, like they're investing in their operating leases, which means they probably have higher optimism about growing and expanding. And which kind of gives you a sign of like, hey, if the industry leaders are doing this, like, what do they know about the buying habits of the customers that we may not know?
Exactly. No, that's a really good point. Specifically Starbucks, I know they've been more focused on expanding globally. So Definitely, definitely a really good question to ask if you're really trying to understand how to adapt your small business or medium-sized business accordingly. So that's a really excellent point, Terrell.
All
All
right.
right.
Next one.
All right, let's jump into next. I want to go back to our friends at Adidas. So, when we looked at them last week, we saw really a lot of the money. I mean, they went down, their number was pretty high. They went down, I think they were at, let me just go up so I don't misquote the number.
It'll be at the bottom of your cash flow statement. So you can
Okay,
look
you're
at
right.
it on the cash
Let me
flow
go to the bottom.
statement.
I know they ended up at $800 million, and that was, I think, from two. Yeah, so from 3.6 to 800, so 3.6 billion to
Okay.
$800 million. I'm sorry, million euros was where they ended. And I know we saw that really the big cause of that was how much money they spent in 2022 on inventory. So we can dive in here. Let me scroll back up. And just for point of reference, this is Q3 of 2022 because they have not yet released, as of today, they have not yet released their financials for the full year.
All right. So first off, a couple things that are jumping out to me are I'm going to look at the big negatives because I know that they went from 3.6 billion down to 806 million, and I need to find out what did they spend money on. And clearly the first couple things that jump out to me is the increase in receivables. Now, most people would think that, hey, if your receivables goes up, that's an asset, that's a good thing. That may be true on your, if you're just looking at your assets versus your liabilities. But from a cash standpoint, that does not end up being very true because what that means is other people are holding on to your money.
Yeah. Yeah.
It's money like, you gotta go collect it.
Money that is yours. Money that is yours that is in other people's pockets.
That is very true. That is very true. And I think that a lot of people don't really think about that from their perspective. It's like, and this is where a lot of companies can be profitable, but be running out of cash because if your profit is based on sales that you made, but you aren't actually collecting the payments from the customers, like you may have potential to collect the payments in the future. But if you run out of cash today, then you're going to be in a world of hurt. Or let's say they also spent another $2 billion on inventory. Now, with Adidas, we also talked last week about, with everything that's going on with the Kanye West's Yeezys line of, some reports are showing that inventory is worth like, $1 billion+ dollars. The question of it is if they throw that away, that is going to be money down the drain. And if you're looking at their cash position, the question is, can they really afford to make a decision like that?
That's a good question. Let's keep going. Find out. So, I mean, I would say what sticks out to me relatively quickly, which I mean, this is something we saw when we saw the increase on the balance sheet, is just their change in inventory. So it looks like they actually had a decrease in inventory the prior year, but now they're actually showing a $2 billion increase in their inventory. And one of the things that we said was a lot of it may have been related to maybe additional inventory purchase to support the Yeezy product line. I was reading one of their I guess supplemental information when they issued kind of some guidance for 2023 and for Q4, and one of the things that they mentioned is they were anticipating with the Christmas season for Q4 coming around, they were actually anticipating that there would be high demand for the Yeezy product. So they, I think, stocked up. This is just my theory. They didn't explicitly say that, but I think a lot of the hike here may be related to the fact that they were stocking up for the season, the Christmas season and the holiday season, to be able to support that. And then they made the decision to exit the agreement with Kanye West, and now they're stuck with all this inventory.
Yeah, I mean, and that's a tough place to be in because I do think for every, for every business is you got to balance that the amount of money that you have on inventory versus, your time of delivery, because a lot of people like to stock up on a ton of inventory because they're like, what if we run out? We want to make sure that we can get it to customers like immediately. But then also on the other hand, you got to weigh the option of, can you afford to spend that much cash on inventory? Because like in this case, I mean, they went from 3.6 billion down to 800 million, which means you need to do a better job on collecting your receivables, and you got to get that inventory sold. But now they're in an interesting place where some of that inventory might not get sold. So the question is like, how big of a hit is that going to be for them?
Yep, and I'm looking forward to seeing it. I think it'd be good maybe just to do like a quick update when they do release their results. I think they're supposed to come out in March 15th. So it'd be interesting to see where they actually ended up and some of the guidance they're providing for 2023. I guess if we go to I want to move on to the investing activities. It doesn't really look like they had anything too big, with the exception of this: proceeds from disposal of discontinued operations, net of cash disposed.
So usually what this is, I mean, that looks like an inflow of usually whether it's some part of their business, or maybe it was a product line that they used to have or brand that they sold to someone else that they're no longer, operating. So it looks like they sold something off for, and they got 1.1 billion from it.
Interesting. I wonder what they sold. Go ahead.
But then when you go down again, you got you got a couple of things here. So the repayment on the lease liabilities, that's money out the door.
Yeah.
And then you got dividends that they issue. And most companies, once they start issuing a dividend, they tend to keep it pretty stable from, year to year, quarter to quarter, because that's them giving money back to their shareholders. Now, the other thing, and we just talked about this with Starbucks, is a repurchase of treasury shares. In my opinion, and this is Terrell Turner's opinion, oftentimes you find that they are doing that to increase their earnings per share, because they're taking more shares off the market. So the people who own shares that still have shares, their shares are worth more because there's less on the open market. Now, I will also say that also plays into a strategy where sometimes instead of paying their corporate executives a salary, like a full salary, is they may buy back some shares to give them like more stock options or more stock when they're trying to figure out alternative ways of paying their senior executives.
That's actually a good point. I never thought about that. That actually makes sense. You buy it back, you improve your EPS, but then you also have a way to put more money in the pocket of your executives. Smart strategy.
Because it's supposed to be a way for the company to give the senior executives an incentive to grow the value of the company.
Exactly.
Because if your compensation is tied to the stock price, then you're going to do what you can to make sure the stock price goes up.
That's a fact. I can attest to that. All right. So the other piece, then, just a couple of more things to cover. I don't really see anything that stands out with the exception of maybe the proceeds that they got. So it looks like they borrowed some money, 496 million. I mean, for us, $496 million is a lot of money, but on the paper, this looks like not too much. But yeah, they got some money in cash inflow in 496 million. And I don't really see anything else, Terrell, that kind of stands out. Do you see anything else you want to comment?
Yeah, what's interesting is, if you look at the ending cash that they had is 806 million. And you look at the size of the loan is 496 million.
Yeah.
Like, to me, it's like, and this would be more of a balance sheet thing, which we don't have to talk about that now. But when I start seeing stuff like that, one of the things that I'm looking at is how leveraged is this business?
That's a
Because
good
what that
point.
means is if something goes wrong, because there's only so much cash you can borrow
Yeah.
before banks start saying, no, you're too risky. We're not giving you any more money.
Yeah.
Because what they would, and this is what I was talking about, like I said, there have been multi-billion-dollar companies that I've seen before where they were 2 months away from bankruptcy because they couldn't take out more loans. The only thing that they were banking on is to be able to refinance a loan that they had outstanding. And I remember going into some meetings, and in the meeting, the conversation was, if we do not get this loan refinanced, the company could go bankrupt. And
I
so
mean,
it was all hands on deck of like, hey, what do we need to do to get this thing over the finish line? Because if we don't get this debt refinanced, so I do think, you do have to keep an eye on that of like, how much debt are you using to fund the operations of your business? Because that exposes you to a lot more risk.
that's a really, really good point. And I think these financials really kind of emphasize on that, because basically what this is telling us is half of the cash that Adidas ended their third quarter with was borrowed. Actually, more than half of the cash they ended their third quarter with was borrowed. So
Yeah.
that definitely kind of leads you to kind of scratch your head a little bit and be like, okay, how close to the end? Like, even if I was to think about like, how much money do they need to run their operations on a monthly basis, on a quarterly basis? Is this even enough? Is 806 million enough, or are they going to have to borrow some more money? And so this kind of, I think one of the things that I've learned from our discussion today, Terrell, is just how risky running big companies, how they manage their finances, especially when it comes to their cash flow. Because looking at this number, this is definitely a concern for me.
Yeah, I mean, it's definitely something to keep in mind. So, I would definitely say is in your business, you do want to look at things like that. It's just, what is your debt levels? What is your cash flow? Do you have enough cash coming in from the core operations of the business so that the business can fund itself? Because if all of your cash is coming from you running to the bank or you taking out short-term loans, there's only so long that you can do that before, hey, banks start saying, we're not going to give you any more money, or, hey, we don't have any more money to give you. And then when you think about that, like, where would you be? So like with
Yeah.
Adidas, I would say is, what would their situation look like if they were not able to take out that $496,000 or 496 million euro loan? What if the bank said no? Then
Oh.
what would their situation look like?
That would be yeah, we're gonna have to see. I mean, we're gonna have to keep an eye out on them, see how they do.
Mhm.
I'm actually
Yeah.
curious. I know we have one more to do real quick, but I was actually curious, and I'm not gonna waste any more time on this. I was curious to see what their expenses look like on a monthly basis, because I wanted to really know how much is it gonna cost them to run the
Well, if
business.
you scroll up a little bit,
Did I go too far?
slow down just a little bit. I would say go down just a little bit more. So your net cash used
Oh,
in
wow.
general, your operating cash flow. So that tends to give us a little bit of an idea on, hey, what's happened, like for the core operations of your business. Did you have a positive cash inflow, or did you end up spending more money than you brought in from the core operations?
Mm-hmm. And if I'm looking
And
at this number, so yeah, they lost 709
yeah,
million.
yeah. So they spent more money than they brought in. Now, some of that may be strategic, like I said, for the inventory. It may be that, hey, they bought more inventory because they had plans to sell it in the future. Then the
Mhm.
question, that you're looking at in the following quarter when they release their updated numbers is, you're trying to see, okay, all right, were you able to sell the inventory that you bought last quarter? Because you made a strategic move to do that. Let's see, were you successful?
Right. All right. Well, we'll see. Okay, I want to go through just real quick Uber before we move on. And just like some really quick highlights. We didn't talk about Uber on the last episode, but we wanted to pick Uber because we actually thought we would have a little bit more time to talk through another company. But Terrell, I want you to kind of do your magic. So this is the statement of cash flow for Uber. I picked Uber because one of the things that you and I talked about earlier last week was just how Uber still is not yet, well, as of the financials we saw, Uber is still not yet a profitable company. So curious to kind of go through their statement of cash flows just to see what they reported in their performance for 2022 and what the numbers look like.
So all right, so if we're looking at this first line that's jumping out to me. I'm looking at net income. That's going to be at the top of your cash flow statement. So the way there's a setup is you have the fourth quarter and then you have the full year. So for the full year, it looks like they lost, was that $9.1 billion?
That's what it looks like. Let me double check that number.
No. You don't have to change that. That is the number. That is the number. It's 9.1 billion. We don't have to look anywhere else.
That is wow. All right.
Now, of course, you start adding back some of your non-cash your non-cash. So it looks like a big portion of that loss is related to some unrealized loss or gain on equities and securities. So it looks like the company is holding some position in some type of, equity security. So
what is that?
7 billion, I mean, it'd be like if they own some other subsidiary and the value in that subsidiary went up or down or whatever.
So like maybe like Uber Eats or something?
I'm not quite sure. I'd have to look at their full 10K to tell that, but it's so the reason why they're adding it back is because the losses that they have on that are not cash. It's not money that they spent. It's just the value of their investment. So, I mean, if you think about that, like they lost a total of $9 billion, 9.1 billion. 7 billion of that was related to this unrealized security. So, I mean, in theory, if you're looking at a cash position, then I would say it's like they didn't completely lose. It wasn't like they just lost $9 billion of cash.
Yeah.
It was something a little bit less than that.
Got it. All right. That makes sense. And so if we take all that out, basically it's saying the cash from operating activities is a positive 642 million.
Yeah. I mean, which I will say is pretty impressive considering, like I said, the dire position that it started in is like they were able to bring in a net positive cash of, like I said, the 642 million. Now, when we get into your investing activity, we're starting to look and see, okay, all right, what did they do in that area? It looks like they spent about 1.7 billion on marketable securities. I don't know exactly what securities they purchased, but it looked like they made some purchases there. So that was cash out the door. So at this point, you had a positive, on the operating side, you had a positive 600. Here you have a negative 1.6. So they're roughly $1 million in the hole based on their decision so far. So let's look at the financing section. All right. So it doesn't look like they took out any major, new loans.
Actually, it looks like, am I reading this correctly, that they paid down some of their loans?
Yep. Looks like they paid down their loans. Yeah, so it looks like they were making the principal payments on their loans. Okay. All right. So I think the net cash activity for them is they lost 1.1 billion dollars in cash. Like they spent 1.1 billion dollars in cash above what they brought in. So I mean, their cash balance went down. Now, I would say they went down from 7.8 billion down to 6.6 billion. It's not as scary as a drop as some of the other companies that we've seen.
Yeah.
But for them, I think a big thing is gonna be is, is if you scroll back up, what gives some comfort is that they're operating cash, meaning they're able to generate positive inflows from their operations, which is
Mhm.
good because that means you kind of have a future of they can survive. It's not like they're trying to survive off of loans and stuff like that.
Yeah, that's a good point. And I think one of the things that I will say that their financing activities, I think, is a good lesson for business owners, because even companies this large, like one of the things that we saw was a lot of, like, for example, we just looked at the Adidas, where they half of the cash inflow was a loan, a short-term loan. So, I think for the business owner, what I would say is, you really need to make sure that your business is properly leveraged, and can your business run and operate on its own without with minimum, maybe not minimum, but with maybe being just a bit more prudent on the financing that you're taking into your business, and really being mindful of how you're using that to really help move your business forward.
Absolutely, absolutely. I mean, I think that there's a lot to learn there. And really is the core thing you said is making sure that you understand where is your cash going,
Yep.
and making sure that we can your business can survive.
Yep, agreed. Agreed. So, thank you guys for tuning in to this episode of the Stuff Your Accountant Isn't Telling You. As we always talk about here, we always talk about applied accounting, and how to use the financial information that we share on the podcast to make profitable decisions. So, thank you so much for tuning in to another episode. Until next time. So we just looked at Adidas's statement of cash flows, and one of the things that jumped out to me is how heavily leveraged they are. And when you talk about being heavily leveraged when it comes to their debt, it's just how much money they borrowed when we're looking at Q3 of 2022 on their financials. And they made, I think it was about $800 million in cash, and half of it, or more than half of it, was actually borrowed through short-term borrowings. And I think for business owners, one of the things that you really need to get really good at, because cash is king, is really being able to understand the money that's coming in from your operations. Are you actually profitable? One. And then two, if you are going to go out and borrow money, you need to understand and make sure that you're not putting your business in a position of risk where you're borrowing more money to run your business than you're actually bringing in when it comes to operating that business. All right. How's that?
Fine.
All right, cool. All right. Do you have something?
No, I'm good. I don't need to share anything.
All right. Cool. I am hungry. All right, babe. You coming in?
Yes, I need to finish something.
All right. Let me end the recording.
Hey, it's your girl, Tia Robertson. I'm the host of Entrepreneur Insider. Every Thursday at 6 p.m. Eastern for entrepreneurs and news that you need to know about. See you there.
Welcome to What's Going On? My name is Demita Joe. Each Wednesday, you can find me here at 3 p.m. I'll be over here discussing different things that are going on and try to bring you a boost of positivity for your week because we all need this. We're going to share some feel-good stories. We might find a hometown hero. We may take a look at some trending topic. And sometimes we might even find a lesson in a not-so-warm and fuzzy story if we can. I'm Demita Joe, and I'll see you guys on the next episode right here on What's Going On?